Welcome to the Riskwiser Zone. I'm your host, Louis. We're glad you're joining us today as we dive into the latest news and trends from the world of stocks and finance. To start off, let's take a look at the current market landscape. Two key stories have caught our attention this morning. First, we have the initial public offering, IPO, of Bluejet Healthcare, which has garnered significant interest from investors. The company is looking to raise funds to expand its operations and invest in new technologies. We'll be keeping an eye on how this IPO performs and what it might mean for the broader healthcare sector. In other news, KRBL, a leading basmati rice producer, has reported impressive Q1 results with a 74% year-on-year increase in profit after tax (PAT) to Rs 151 crore. The company's revenue from operations also rose by 32% to Rs 158.4 crore, driven by strong demand in both domestic and export markets. This is certainly a positive development for KRBL and its investors. We'll also be discussing the Bluejet Healthcare IPO in more detail later in the show, including what investors need to know before making any decisions. For now, let's take a closer look at KRBL's performance. The company's EBITDA margin improved to 13.9% from 11.4% last year, and its gross profit margin expanded to 25.7% from 23.2%. These numbers suggest that KRBL is doing well in terms of operational efficiency. However, it's also important to consider the broader market context. As we've seen in recent times, market trends can be unpredictable, and investors need to stay informed to make smart decisions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. I'm your host, Louis, and we're glad you're joining us again for this exciting segment. Today, we're diving into a fascinating story that's making waves in the tech industry. You might have heard about it, but if not, don't worry, we've got you covered. We're talking about the recent deal between U.S. semiconductor giants Nvidia and Advanced Micro Devices, also known as AMD, to pay the U.S. government 15% of their revenue from sales of artificial intelligence chips to China. Yes, you heard that right, 15%. This unusual agreement was reportedly brokered by President Donald Trump himself. Now, let's break it down for you. The story goes that Nvidia CEO Jensen Huang met with President Trump at the White House last week and agreed to give his administration a share of the company's revenue from sales of their AI chips to China. As a result, the U.S. Commerce Department began issuing licenses for the sale of Nvidia's H20 chip to China. But here's the thing, this deal has raised some eyebrows, especially when it comes to national security concerns. Critics argue that selling these advanced chips to China could accelerate their AI capabilities and pose a risk to the United States. On the other hand, the Trump administration maintains that the chips are less advanced than those sold to allies and that the deal strengthens U.S. tech dominance. We also have to consider China's perspective on this issue. They've raised security concerns over Nvidia's H20 AI chips, claiming they may contain backdoors. Nvidia has denied these claims, insisting their products do not allow remote access. As we weigh the pros and cons of this deal, it's essential to remember that the tech industry is a complex and ever-evolving landscape. We need to consider multiple perspectives and potential consequences before making any judgments. So, what does this mean for you, our listeners? Well, if you're invested in the tech industry or concerned about national security, this story is definitely worth keeping an eye on. We'll continue to monitor developments and bring you updates as more information becomes available. And that's all for this segment of the Riskwiser Zone. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. As we wrap up today's episode, I want to shift our focus to a pressing global issue that has significant implications for investors and economies around the world. The ongoing trade tensions between major nations have been making headlines, and it's essential to examine the potential risks and consequences. Recent developments suggest that the trade war is far from over, with tariffs and counter-tariffs being imposed by various countries. This has led to concerns about the impact on global economic growth, inflation, and the stability of financial markets. The situation is complex, with multiple factors at play, including geopolitical tensions, currency fluctuations, and shifting global supply chains. According to a recent article, the trade shock amounts to 25% this year when you add in euro appreciation against the dollar, or a de facto 60% shock on metal products. This has significant implications for industries that rely heavily on international trade, such as manufacturing and agriculture. Companies like Caterpillar and Molson Coors have already warned about the potential costs of these tariffs, with estimates suggesting that they could face losses in the billions. It's also worth noting that the European Central Bank's decision to maintain its current monetary policy stance has been questioned by some experts, who argue that more needs to be done to stimulate economic growth in the region. The Eurozone's rebound has stalled, and Germany's industrial output has fallen significantly, which could have a ripple effect on the global economy. As investors, it's crucial to stay informed about these developments and consider the potential risks and opportunities in your investment portfolio. While some may argue that the worst is over and stability will come, others believe that the situation remains uncertain and volatile. At the Riskwiser Zone, we strive to provide you with balanced and unbiased information to help you make informed decisions. We encourage you to stay vigilant, diversify your investments, and be prepared for potential market fluctuations. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.